Hello students and welcome to Finance for Engineers course. In previous lecture, we had discussion concerning to non-discounted cash flow techniques used for evaluating investment proposals of the business organization. You must have understood that two methods come under this criteria or technique, that is payback method and accounting rate of return method. Payback period method in capital budgeting refers to the period of time required for the return on an investment to repay the sum of the original investment. This payback period is an effective measure of investment risk. Normally, the project with the shortest payback period has less risk than with the project with longer payback period. The payback period is often used when liquidity is an important criteria to choose a project. Payback period method is suitable for projects of small investments. While talking about the accounting rate of return, it is a capital budgeting metric that's useful if you want to calculate an investment's profitability quickly. Businesses use ARR method primarily to compare multiple projects to determine the expected rate of return of each project or to help decide on an investment or an acquisition. It is the percentage rate of return that is expected from an investment or asset compared to the initial cost of investment. Then we also solve some problems, examples related to evaluation of investment proposals by using payback period method and accounting rate of return method, where I highlighted the basic difference between two methods. That is, in payback method, before calculating payback, we first deduct depreciation from the cash inflow. Then we require to calculate tax and then we deduct tax from cash inflow and then again we add back depreciation. While in case of accounting rate of return method, we deduct depreciation and tax, but we never add back depreciation. After that, we had discussion concerned with second criteria used for taking investment decision. That is discounted cash flow criteria, which consider the time value of money. Under this, three techniques are there. First is net present value method, second is profitability index method, and the third one is internal rate of return method. In net present value method, the cash inflow, that is expected at different periods of time, is discounted at a particular rate, and the present value of the cash inflow are compared to the original investment. If the net present value of a project or investment is positive, it means that the discounted present value of all future cash flows related to that project or investment will be positive and therefore attractive. Let us see an example which will help us to understand the difference between the results we derive without application of time value of money and by application of time value of money. So this is an example in front of you. A company is looking to invest rupees 1 lakh in a project. The required rate of return is 10%. And the following information is given concerned with projected earnings of project A and project B. So we can see that project A and B are mutually exclusive projects. So here you can see project A, year 1 cash inflow is rupees 10,000, year 2 cash inflow is rupees 12,000, for year 3 it is 20,000, year 4 rupees 42,000, year 5 rupees 55,000, and year 6 it is rupees 90,000. So as like project A, project B is giving us in a first year rupees 15,000, in second year 27,500, third year 40,000, then fourth year rupees 40,000 again, in fifth year rupees 45,000, and in a sixth year rupees 50,000. It is expected that you should suggest the company which project is profitable. Now first we will see, without using time value of money, what is the profitability of the project A and project B. So here you can see a table which is given us an information concerned with profitability when time value of money is not considered. So if you observe the figures given, this is the information given in an example concerned with project A cash inflow for all the 6 years is written. Then for project B, again, whatever information is given in a example, the same is written for all the 6 years. Then next is cash inflow. Total is taken here 2,29,000 in case of project A and 2,17,500 of project B. Next is initial investment for both the project is same, that is 1 lakh rupees. Next is net cash inflow is calculated by deducting initial investment from the total cash inflow, that is A minus B, and we derived the amount 1,29,000 in case of project A and 1,17,000 in case of project B. Now we will see, if we apply time value of money concept for the same example, what will be the result? So in the same example, however, if the time value of money was considered, so this is a table, profitability when time value of money is considered. 10% discount factor is already given. So calculated 10% discount factor for 6 year, and by this way we have derived present value of cash inflow for project A and project B, which is mentioned here. You can see all these figures. Just we have multiplied 10% discount factor for the given cash inflow in example, and we have taken total discounted cash inflow 1,47,625 in case of project A, and for project B it is 1,49,855. Initial investment, again the same amount we are going to apply for both the project, that is 1 lakh for A and also for B. And then applying the same formula, that is net cash inflow is equal to Total discounted inflow minus initial investment, we derived 47,623 in case of project A and 49,855 in case of project B. So now here you are expected to give suggestion to the company which project is uh, beneficial to the company. So if we never apply time value of money, we can see that the project A would be considered profitable with a net cash inflow of rupees 1,29,000. But when we apply time value of money, then project B is more profitable in terms of the present value of future cash flows with a discounted net inflow of rupees 49,855. So it gives us a real picture when we apply a time value of money, and here our results are totally different from the earlier one. Okay, so without applying time value of money, our answer is something different, and when we consider time value of money, our answer here is changing from project A to now project B. Now here you can find that project B is profitable one. So that is why this particular method is very significant from this point, business organization point of view. Now the next is discounted cash flow criteria. Under that, second method, profitability index method. The profitability index is also alternatively referred to as value investment ratio or profit investment ratio. It is also known as the benefit cost ratio. The index is useful tool for ranking investment projects and showing the value created per unit of investment. And the formula used for calculating profitability index is present value of cash inflows divided by present value of cash outflows. See here, this is the accept and reject criteria used for PI method. We can accept a proposal, we can suggest a company to accept proposal when PI is greater than 1. That means calculations greater than 1 indicate the future anticipated discounted cash inflows of the project are greater than the anticipated discounted cash outflows. One can suggest the company to reject a particular proposal when PI is less than 1, which indicate that the deficit of the outflows is greater than the discounted inflows and the project should not be accepted. If the calculation equals to 1, that means it brings about situation of indifference where any gain or losses from a project are minimal. Thus, it can be understood that when limited capital is available and projects are mutually exclusive, the project with the highest profitability index is to be accepted as it indicates the project with the most productive use of limited capital. The profitability index is also called the benefit cost ratio for this reason. Although some projects result in higher net present value, those projects may be passed over because they do not have the highest profitability index and do not represent the most beneficial uses of companies' assets. So let us start with an example where we will see how to calculate net present value and profitability index of the particular project. Beta Private Limited, Pune is considering an investment proposal to install new mailing control at a cost of rupees 50,000. This facility has life expectancy of 5 years with no salvage value. Tax rate given is 35% and firm is using straight line method of depreciation, and following is the cash inflow given, which is before depreciation and tax. So 5-year information concerning to cash flow before depreciation and tax. Now they are saying that you are required to compute net present value and profitability index at 10% discount factor. Following table shows the 10% discount factor. So there is no need to calculate a discount factor. Let us see how to calculate the net present value of a particular project and then the profitability index. Let us see solution. Here you are required to calculate cash flow after tax before depreciation. And this table you can see again same column we have created particulars and 5-year. Then in particulars cash flow before tax, the information which they have already provided us in an example, we have written less depreciation. By applying formula, we have calculated depreciation, and as it is a straight line method, we have written for all the 5 years. Then after deducting depreciation, we arrived at PBT. Then on PBT, we have calculated tax at 35% and written. Then we deducted tax from PBT and we arrived at PAT. You can see here in a first year 0, second year 450, in third year 1800, fourth year it is 2250, in fifth year it is 6750. Then again we are adding back depreciation, and after adding it we arrive at cash flow after tax before depreciation. So now we have to consider this figure for further calculation. Next, we are required to calculate net present value. Now here there is no need to apply a formula of NPV because they have given us 10% discount factor already. So in this manner, we can present our data. First column year, second is cash flow after tax before depreciation, which we have calculated in earlier statement. Next column is concerned with present value factor, which is again given in an example. And now next is total present value. So total present value we have calculated by multiplying present value factor to cash flow after tax. So multiplication of second and third column gives us total present value of cash inflow. Then after calculating total present value for each year, at the end we are taking the total of total present value of cash inflow, that is 45,352. Then we deduct initial investment from the present value cash flow, and thus we arrive at net present value. It is written in a bracket, that means it is a negative figure. You can see here 50,000 is an initial investment, and from employing that particular project or by purchasing that particular asset, the firm can able to earn only 45,352. That means our investment is more than the returns whichever we are going to get from that particular asset. So that's why net present value is in a negative. That means the particular project is not profitable to the company. This is about the net present value method. Let us see how to calculate PI, profitability index. So this is the formula. By applying formula, we can calculate the profitability index. The formula for calculating profitability index is total present value of cash inflow divided by initial investment. So 45,352 divided by 50,000 gives us 0.907. So by applying accept or reject criteria, one can suggest the company whether to accept a proposal or reject the proposal. So if we see net present value, it is negative. That means it suggests that the company should not accept this particular asset. At the same time, profitability index also suggesting us not to accept a proposal because it is less than 1. So we can suggest the company that the company should not accept this particular proposal as net present value is negative and profitability index is below 1. Let us see another example. Concerned with machine A and machine B, cost is same for both the machine, rupees 56,125. Next information given is income after depreciation and income tax. For 5 years, data is given of both the machine. Then estimated life in years of both the machine is 5 and salvage value is 3,000. So calculate net present value and profitability index for both the machine and suggest the company which one is profitable. And one more information they have given, that is cost of capital 8%. So let us start with the solution. Machine A, statement showing cash flow after tax before depreciation. Here already they have deducted depreciation and tax. That means the information with us is concerned with PAT, and we are required to add depreciation. So we need to again calculate depreciation amount and then add it back to the profit. So thus we arrive at cash flow after tax. Now here they have given 8% cost of capital. In earlier example, they have given us table which gave information concerned with discount factor. But here there is no information concerned with discount factor. Only we have cost of capital rate, that is 8%. So we will apply our formula of NPV and calculate the net present value of machine A. So you can see here cash inflow 15,600. First year cash inflow we have taken, then divided by into bracket 1 plus 0.08 is the rate of cost of capital plus second year cash inflow divided by into bracket 1 plus 0.08 bracket complete raised to 2. So that is, this is nothing but number of year. So this is in a second year, third year, fourth, fifth, and again we are considering this. Now till this we have completed fifth year 22,400 in a again in the same year, that is in a fifth year, we have to consider this 3,000. This 3,000 is a salvage value of an asset. We have to consider the same while calculating net present value of the asset. So 3,000 and the rate of the same year, fifth year, because the life of an asset is 5 year. So at the end of fifth year, this is the salvage value, that is 3,000. So therefore, we are considering the same year for discounting that particular amount. Then bracket complete minus 56,125. This is an initial investment, whatever we are doing for acquiring that particular machine A. So by this way, we have calculated and we arrived at NPV. The amount is 22,267. Next is by using PI method, we arrive at 1.40. That means profitability index of machine A is 1.40. So here you can see NPV is positive and PI is more than 1. That means our machine A is profitable for the business firm. But we have machine B for comparison. So let us first calculate NPV and PI for machine B. Then we will compare between the two, and then after that we will suggest the company which one is beneficial, which one is profitable to the company. So let us see the calculation concerning to machine B. So the same statement here we are required to prepare, that is of cash flow after tax before depreciation. Same procedure we are going to apply for machine B, that is PAT is given already in an example. We again calculate depreciation for this particular machine B by applying formula. Then we will add back depreciation and we arrive at cash flow after tax. And this information we are going to apply for calculating net present value of machine B. The same formula we will apply here. And again, we have to consider the 3,000 salvage value, which is we are going to get at the end of fifth year. And then deduct 56,125, which is the initial investment. Thus, net present value of machine B is 31,956. Next is PI. By applying formula, we arrive at PI 1.57. Now, when we compare between the two machines, you can find that machine B is profitable. Why? Because net present value of machine B is more than machine A. At the same time, profitability index of machine A is less than machine B. So both the machines are giving positive results. Both are in an acceptable criteria, but NPV of machine B is more than machine A. At the same time, profitability index of machine B is more than machine A. Therefore, we can suggest the company to purchase or to invest in machine B when compared with machine A. So for evaluating investment proposals, one can use NPV and PI method and suggest the company which one is beneficial. So here I am ending my session. Thank you.